Uh, Welcome back. This is the second week of the weekly briefers for an up and coming investment firm, a form of self promotion and spokesmanship. My name is Cadis Brooks. So, we got a few things to go over today. I want to talk about reading about financial history, especially crises, and then also the history of fraud in many of the crises, but in the financial history of markets in general. I want to talk about recent gold stocks and their performance, and some potential investigation into that as well. Um, there's going to be some general advice again from Buffett's that I'll go over again. We're going to link this into a common take on cryptocurrency and what I think. And then I'm going to get into some basic fundamentals of investing, and skills development, financial development. And then I'm going to touch again on a little bit of foreign policy, as again, one of my major specialties is foreign policy, political science, foreign affairs, international relations, and that kind of thing. So, I have been reading this one here. It's very interesting. It's called Den of Thieves. Actually, the job that Stewart did, the author here, is very good. He's a political science expert, but also he was a journalist, and I'm actually really surprised about the depth of the specific facts that he gets in this history. But basically, the book is one of many on very dangerous, predatory fraudsters in stock markets. This one here goes over Drexel and Siegel, Boski, some of the really big names in financial fraud in the 1980s. And I bring this up because I'm particularly interested in studying how fraud is going to occur to me or other investors in the stock market. We all understand that the stock market is full of fraud. I can't deny that. That's why the SEC exists. They're an active investigator. There's such things as the Stock Act, and so legislators are on this too. And it's such a big issue that I think, and it's so hard to fathom that you have to delve deep into how these people are doing this fraud to protect yourself. So you have information. It's not enough to just say, yes, I know that there must be something going on here. There's some fraud happening. And then you start blaming the stocks as if they knew what you were doing as an investor. And you start coming up with irrational ideas about how fraud might be happening to you. Much better is it to actually determine how these guys are doing fraud. So that's why this one's particularly interesting. One of the main ones here is that there's all sorts of predatory insider trading. There's investment bankers that in their spare time would go to the ends of breaking into firms and taking documents about mergers and different forms of trades that are about to happen, and then having that foresight to invest in the stock market. And these people had made so much. Some of these guys, they did time in jail, and there was quite a few penalties So they definitely didn't get away with it. But of course, we as investors don't want to be left in the shadows and not understanding how exactly fraud could happen. And um, one of the major things about investing in the long term is that you're able to kind of weed these times out of particularly suspicious trading, and that's one reason why it's always solid advice to avoid day trading, because that's where you tend to pick up a lot more of the short term insider buyers and sellers. And among others, unfortunately, committing fraud in the stock market. So it's not that you can't make money off the stock market. It's actually a really great resource because it allows anybody to enter the market and purchase shares of businesses, become owners of businesses that they might not have the opportunity to participate in without the stock market. It allows you kind of ownership of stocks and that potential without having to actually operate the business or compete in that sense when you're an owner operator or any kind of operator for that matter. Another thing very interesting actually in the reading department is the history of financial crises, and I'm pretty sure it was Ben Bernanke that mentioned that he was a student of the 1920s stock market crash, and probably among others. And after hearing that, I thought it was quite interesting to get into reading about the various crashes, because when I was first an investor, probably like many of you, I didn't understand that there were lots of crashes, and that was actually quite common. I didn't really understand what the business cycle meant, and after seeing so many crashes and the different ways that the crashes had happened, I gained more of a comfort in dealing with crises and actually turning those situations into great opportunities, as I did, as you heard from the last video, where I profited one time after the next of the last year and a half because of the COVID crisis. Now, one of the crashes that I had been reading about recently is actually the internet bubble, the dot-com bubble, and that was roughly around, I think, 2000, right around there. The internet had just really started to take off, especially in the stock market, and I encourage all of you to at least watch documentaries. They're pretty reader friendly or beginner friendly, and what you can see from this one is the major fraud that occurs with what they call IPOs. Now, an IPO is like a new release company, and I always recommend that you don't touch the IPOs, don't get into it unless you have lots of experience dealing with IPOs. But basically, in the 2000, the dot-com bubble, there would be banks that were ruthlessly, I'm talking even about like Goldman Sachs and very popular investment banks, the salespeople for these banks would ruthlessly look for any internet company, any company that has the internet attached to them, and they would offer them IPOs, the ability to become an IPO for the company at various prices that were a complete ripoff to the people potentially buying them. And so basically these companies would be released so that investors could invest into them, and these companies weren't profitable. They had no proven profits, and it was the speculation that if they got into the internet, they would just explode and be the next Amazon or Apple. And so you had a whole rush of investors, usually retail investors in the sense of small-time investors, come in and buy these IPOs, and they could see just a devastation to their wealth in no time whatsoever. And And what was happening is there was lots of inside buying and selling. So you had these tours that the companies that were creating the IPOs would do, and they would go to different private equity firms and different kinds of funds, and they would invite them, and they would offer the stock at a much lower price than what it would become with the IPO. And then, of course, you had all these shares owned by these different private firms and different funds, and they were much lower than what the market price was going to be with the IPO. And so as soon as it was released, or very soon after, they knew the stock was much higher than what they had paid on the tour for the kind of private deals, but stock could even go higher with all the speculation, and then they would sell rapidly, and all these buyers from the retail side of things, the small-time buyers, they would buy at these higher prices and just see the stock just crash, and it multiplied. So that for instance is a great example of how you can actively research. As anyone, you don't need to be going to school for finance or anything like that. You can actively research past instances where there was major fraud or major insider trading or anything like that, and you can learn from it, and hopefully you won't have the experience of purchasing some of these IPOs, and they got lots of media on them really trying to sell those shares. And I mean, they say they've kind of cleaned it up and made it more legitimate, but I hear of many people getting absolutely ripped off by these IPOs, and they wish it had never happened, and sometimes they'll just stop investing, which unfortunately isn't the right idea with bond prices, bond yields being so low. But one of the major ways to avoid these kinds of huge losses in stocks, especially when you first start, is to actively seek out advice. And I said that last time, and I'll say it again. Find good sources of advice, cross-reference them in the sense of compare what they have to say, form a good judgment. There's lots of great information out there. There's people like Warren Buffett that put out very genuine, good strategies of investing that will be a great opportunity for people, retail and other. And so that tends to be one of my strategies. Is especially helping the lower end investors, and then also to show the kind of experience that I have in financial markets, so they can see a developed kind of platform. But now there's other interesting things you can cull from the history of financial markets and whatnot. I think on the last point there, one thing to really notice is that these financial markets, they crash much more often than you would think. It's often called a business cycle, where businesses go through recessions, then progressions, and then kind of recede again, and they continue to do that. We obviously don't know exactly how long you will have a bull market or a bear market in, but you're going to have to prepare for both, and be ready to be one of those buyers of shares that are far undervalued in a bear market. But now, discussing the COVID crisis again, I was actually quite a big fan of gold stocks. I made a minor bit of money when COVID was first announced, that governments were shutting down. They had no idea what the virus was about or what to do, and these gold stocks were just surging. I mean, we're talking about there's a range of them. You can find them online. All the major gold stocks, Eldorado is one of the big ones. Kinross. There's many of them in Canada. But what you'll notice is that during that uncertainty, it surged, but then there was much expectation that these gold stocks would either continue to surge or do fairly decent, and then at some point surge again. After the 2008 financial crisis, you'll see that many stocks in the gold sector were surging about a year after the 2008 financial crisis. I think it was at the top of the financial crisis, and you'll see that it didn't happen this time, and actually gold stocks have been continuing to trend downwards. But instead, what you'll see is cryptocurrencies actually doing much better, and a lot of people are saying that cryptocurrencies are going to replace your gold stocks as a kind of hedge to give you more safety due to potential crises. Crisis happens, and part of your portfolio is going to go up if you're in gold or cryptocurrency. Now they say, at least that's the theory. I don't know if that's exactly why cryptocurrency has been surging consistently over the last while. Definitely a potential. Cryptocurrency is difficult to analyze, but we'll get into that a little bit more. Now the gold stocks, you would expect them to have done better than they have now. I mean, they're doing just horribly, completely against any expectations, because when countries are printing out more and more money, what that does is it brings doubt into that currency, at least worldwide, and investors will take their money out of stocks, out of paper in general, currency in general, and they'll move into gold as a kind of protection, which would lead to massive major sales and popularity in the gold mining companies. But for some reason, and I think it's difficult to analyze, for some reason these gold stocks haven't done well. Yet I think that their sales have actually been quite well. If you take a look at their income statements and so forth, their sales have been good. And I'm thinking, I was reading this interesting article about there being some sort of price manipulation or some sort of government intervention in keeping gold prices low, keeping gold stocks low, and kind of off the grid. And I think this was a UK study, and I think that potentially what these governments want people to do is stay away from gold, because it acts as a currency backing mechanism. Still, there's many countries that don't necessarily want to go to the extent of having a gold standard, but they definitely want to mix their assets with lots of gold and oil and other assets that are going to back the currency and show that they're good for the money that they're printing. So, but then there's also other countries that have been selling off their gold, right, and not interested in coming anywhere near a gold standard. So all I'm saying is that this is a high-level analysis and investigation that would need to be done. Gold is therefore a risky endeavor. I used to really like gold stocks because I've got the political science background, political economy, understanding the true value of a dollar and how it needs to be backed by gold, and the great history of gold as real currency. But at this stage, I would have to say that it is a risky investment. I will give a pointer that Warren Buffett once said, and he said that overall the mining industry, just in general, is a cost-intensive industry, and that investing into most mining in general is, now we're talking about for like metals like iron and zinc and so forth, investing into these, you're going to underperform the other markets that tend to do quite a bit better, like financials and consumer cyclicals and those other industries that Buffett specifically prefers. So taking his general wisdom, and of course he's probably the best investor of all time, we could say. He knows what he's talking about. He's going to often outperform the market and many other investors. So just from that point, you could say, hey, well, maybe I'll just stay away from mining in general, regardless of the investigation. And I think that is actually a really solid position, just despite my favor for these gold mining companies. I mean, I come from Canada. It's a natural resource economy here, so we definitely appreciate our great mountains and so forth, where we can mine. But you can always follow that Warren Buffett principle to just stay away from the mining industry. Obviously, this is going to be different for governments and big funds that want to, of course, not necessarily want to profit as much as they want to expand those industries for other economic purposes. But even at that rate, I mean, the way I would see gold as a good investment, if it functioned the way it was supposed to function, would be that, of course, after a crisis, you're investing into gold and it explodes. Maybe you say the market hasn't crashed in a really long time. It's been 7 years. There hasn't been a big crash. 10 years. There hasn't been a big crash. You say maybe it's about time that we get into some gold companies that pay a decent dividend, 2% at least, and we just kind of wait things out. Not wanting to be one of those victims of the market. You're staying in the stocks for 10, 12 years, and then you don't think a crash ever going to happen, and then you're going to sit there with all your money in stocks and they're all half valued, if not worse, once a crash comes around. No, instead you're going to be in a good hedge kind of stock, pays a decent dividend, so you can kind of wait things out. So that was my idea about gold. Now, some people say, well, if not gold, let's go cryptocurrency, and I would just caution against that. We don't exactly know if cryptocurrency is going to be backed by any states in general, and I think that people really got to decipher real money, the real loonie, the real dollar from cryptocurrency. One is backed by the state. Although it's a piece of paper, your $100 bill, and cryptocurrency is just some sort of digital code or asset. They aren't the same thing. They aren't comparable because this $100 bill is stamped and used by the state, and so it's going to be interesting to see how the banks welcome and utilize cryptocurrency. What's going to happen with that? I know there's been a lot of hype about a lot more people rushing to cryptocurrency, especially as like I said, something other than cash or gold. And it could be one of those very dangerous times, like the tulip crisis in Europe, which was centuries ago, but it showed a really good lesson. These tulips used to be valued so highly, and the tulip has no value, of course, it's just a flower, but it was like a show of your wealth, because it was a modest Protestant time where you weren't really allowed to show wealth in ways, and that there was strict customs around how money was used. But regardless, the tulip crisis showed that you could buy a tulip at any price so long as you could sell it at a higher price, and they kept thinking it was going up, but there was no intrinsic value behind the tulip, so eventually the thing crashed, probably due to massive sell-offs, which is again another great lesson to cull from these financial histories. I'm quite a bit of a scholar. I really do appreciate the knowledge you can gain from constant study. So those are my points on that. I now want to take it more to the side of advice that I really do prefer. What I would always tell people is that when it comes to finance, when it comes to economics and business, you want to develop skills throughout your whole life. Be constantly investing to yourself, your education, your health, your skills. Go to school, just take an accounting class, You don't need to go for the whole business degree, but take some classes, ones that you know are going to be good. Upgrade your math, learn a new language, take up a new sport. The essential thing to do is to keep sharp. I think Plato. I am a Platonic researcher myself, but one of the main things that he always taught was to stay really sharp in mathematics and language, and it makes you so much better, infinitely better at all the different skills of life. It makes you far quicker of a thinker than others, and there's nothing more important than being skilled and sharp when you're in the affairs of business. You definitely don't want to be caught in the stock market. Lots of money. You get lazy. Even Buffett said this himself. He's made mistakes before, and you make some dangerous error because you didn't go through the calculations that you needed. You weren't motivated by the math. I mean, take a break if you have to. But the lifelong skill is very important. There's always another really good class to take. Get your driver's license if you don't already have it. Get your different certificates. Another thing is, invest into your health, your friends, your family. Don't be overly concerned about finances all day, and you're in such a pressurized situation all day, worrying about the stocks, looking at it all day. Don't bother with all of that. That's not the point of investing. You don't want to be a day-by-day trader in any way that's worried about upticks and downticks. That's not how we invest. We invest for the long term. Of course, it's going to be fun to invest into markets and learn about the research, expand on topics that are quite exciting. It's obviously quite exciting to hear that a crisis could really be an opportunity. Getting into the history of that's great. But at the same time, don't let it take over your life. Even business in general. When you're a business owner, it's not the point to work 60-hour weeks all the time and just get richer and richer. And I would much rather prefer to have a good family, good society, and so forth. I would encourage people to be socially and politically active too in your community, volunteer, help. You'll even see in some of the most successful investors that at the top of their career, what they end up doing is they end up becoming great philanthropists in the sense of supporting lots of charities, creating their own charities, putting a lot of wealth out there to help people, and committing to their families and so forth. And that's very sound advice. They will be there in times where you're high or low, and that's the true importance of business and finance. On my last points, I'm trying to keep these weekly briefers a little shorter, but as far as foreign policy is concerned, I'm actually quite interested right now in I guess, the problem of China, especially with regard to the chip shortage. And now you have to understand that China in foreign affairs has been marked as an up-and-coming power, as a kind of communist, despotic type of country that is opposed to Western values. This has always been a topic for U.S. foreign policy. So the U.S. and the U.K., they have opposed China in many ways. Canada, we are less in a position to merely oppose various countries. We like to keep diplomatic relations at their best, and we see the world not as any one power ruling or dominating, as unfortunately many policymakers, even in the U.S., might think. They may think that they're the dominant power, they're the ruling country, the world. We see it more as an assembly of various governments forming alliances and working together, forming blocks, and it's like an alliance game chessboard, as I would say in university. So we have attempted to increase our trade relations with China. Now, I think that Canada is in a better position towards China than, and I know there have been some diplomatic issues with regard to, I think there were hostages or something like that taken as prisoners in Canadian nationals in China, but I'm talking about the more general history. I think that Canada has been well positioned to do trade with China, and we understand that they are the number one maker of electronics chips for computers and the computers in cars and cell phones and so forth. And we have to understand that Trump's policies probably went overboard with the tariffs towards China and this kind of back and forth trade war, if you will. And so the chip shortage didn't just come out of nowhere. Of course, these barriers that the U.S. had created has, to a great extent, caused this kind of shortage. Now, there has been some speculation from very experienced investors and researchers in the markets that says that these chips, they're so fundamental to the production and the assembly lines of the major technologies that all of the different industries use, that the shortages could quite potentially cause the next crisis, stock market crash, very major. And so the point here is that the barriers that the U.S. and China had made has created this kind of chip shortage, and I think that if Biden was interested in kind of tackling this issue, the best approach, and Canada could definitely assist with this, would be to mitigate the barriers that were put up, and I know that the U.S. Tends to really see China as this rising power and this dangerous communist country, and they have to leave their differences aside because, to be honest and quite realistic about everything, we all do major trade with China. We depend on them to a major extent. If they had a better plan of making these chips themselves or any other production for that matter, the U.S. probably would have done that by now. So they either got to have a really good plan B and then let the trade relations continue to wither between China and the U.S. and China and the allies in general. So they got to have a really good plan B if they're going to do that, or they got to have a stronger, peaceful, diplomatic conversation with that major power. I think it's quite silly to think that any one country is going to be the next superpower and have world rule or anything like that. So we can already see that the China economy has taken many hits, especially with Evergrande, and there's an ensuing crisis with the major debts that they have as well. And no one country is invincible or anything like that, and it's a friendly game of politics in the international realm, and I think that it will have a direct impact on the markets. Trump, he made a lot of major grand moves, very sporadic and unpredictable, but of great consequence, and to be honest, many times to even make them valuable in any sense, he would have had to plan much better and really back up with many plan Bs these grand moves. I would take a look into reviewing many of his foreign policies and his stances, and making the situation better, righting the wrongs that have been done in the past. As I said, with Canada and the U.S., I don't know how that ended up in such a disputatious situation, but for some reason, the U.S. and Canada, great allies for the longest time, always been, of course, by Canadian, by U.S. to some extent. I think that there's a nationalism that is embedded in everybody, but to see the nationalism actually contradict the great alliance relations for so long that we've had is just obscene. There had been quite a few moves, but I am a critic of Trump. I don't really like to take partisan positions in any way. I like to look at things as they are. A bit of a realist in that sense, and I like to be quite critical of any false move or mistake, and try and improve from the situation. And the last point on, I guess it's not necessarily foreign policy, but government policy in general, is that I am pro-market as much as I can be. I'm always thinking about buying more shares, not selling. And I think I'm going to be that way for the next 10 years at least, because I don't think that the governments will shut down any more than they have already, at least not in Canada or the US. I think that despite the virus having done quite a bit of damage, these governments just can't afford to keep people out of the assembly lines, not producing for their nations, not working, not making money, and paying taxes. They can't continue to subsidize these people's lifestyles. And from what Bill Monroe said, is that the government just can't afford to shut down any longer. And I would extend that even further and say that there won't be any time in the near future where shutdown is economically feasible. And so even if you will see a correction in some of these stock markets, in some of these stock market industries, you might see stocks go down 20%, maybe 30%, but in general, I would say that the market, the S&P, would be at most susceptible to kinds of corrections, which you can just ride continually out. You don't sell at a time when there's a correction going on. You don't hold lots of cash. Unless you're holding cash for other business purposes, like what Warren Buffett does. He's interested in buying businesses and taking full operational ownership of it, not talking about shares. And he's wanting to be ready for good deals. People tend to call people like Warren Buffett when they're in a time of need, and he's able to capitalize on good deals, but not for general stock markets purchases of shares. I think that it would be a sound policy to at least have 5 to 7 years of as much stock market investment as you can. Continuously buy shares up or down. Don't sell at any corrections. Continue to buy on a periodic basis throughout any corrections and even afterwards. Stop trying to make any predictions about when things are going to correct or getting worried about interest rates or anything like that. Be a constant purchaser of really good shares. I'm obviously invested myself in a couple of shares, which I'll go over again, but I would give that at least 5 to 7 years, even 10 in my opinion, and then at that time I would diversify my portfolio with cash and very resilient stocks like TELUS or other network cell phone service providers, utility stocks, major stocks that aren't going to be affected by a crash. And then at that time, you can hold on to those. They'll pay a good dividend, of course, because you're going to choose one that has those 4 principles I mentioned. Dividend paying is one of them. And you're going to hold that until another potential crash at the end of the business cycle. And then you can sell those at a good price. There's going to be a good volume for the stocks you choose. and then you can capitalize from that point with your cash and these really stable defensive stocks and purchase good deals in the stock market. Great long-term strategy. I can't emphasize the importance of that kind of long-term strategy, and that is regardless of the day in and day out fluxes of stock market perception, what's popular or not, different news, day trading, fraud, all of these problems that, of course, aren't very fortunate for us, but there was a good quote that we don't depend on them not coming, we're prepared for them coming either way. And so, again, just on the last point, my two major stocks, I don't like too many stocks at once. I went over diversity in the first video if you're interested in that. My two stocks, Suncor out of Canada, there's a US version of it too, it'd be the same company, and then also a TSX venture stock, and that's a UFC. It's an urban fund, high growth real estate investment trust. And if you want to know the fundamental reasons for those two stocks, please watch the first video. But they're both undervalued. The Suncor with oil crunch right now is going to be doing very good, but then it also has great long-term future prospects. It's going to be multiplying its dividend by 4 over the next while. And that urban fund stock, the UFC, is having a trend of upward volume, and it's very cheap to get into real estate through this stock. It's kind of a way to bypass the high prices in the market for very valuable, stable assets as real estate, and get into them very cheap through the stock market and watch them grow from there. Okay, please subscribe to the weekly briefers. I'm interested in continuing to promote my business strategy and share great wisdom and advice from the various books, strategy books, history books, political science, and then also the news, credible sources like the Financial Times and the National Post and Bloomberg, and then also share some of the wisdom from great sages as Warren Buffett, Charlie Munger, and otherwise. Have a great night. Thank you very much.